In order to understand the variety of often confusing terminology relating to ethical and socially responsible investing and the different strategies available in today's market which are aligned to this theme, it makes sense to take a look through the history of ethical investing. We will take a journey from when ethical considerations were first integrated into investments all the way to the present day, highlighting how quickly it gained momentum and how it has continually evolved to meet the changing needs of our society and the world in which we live. Along the way, you will understand how the various terms used for ethical investing came about as the investment universe grew and matured, which has put this area of investing well on its way to moving from niche to mainstream. 1700s. Religious establishments were the first to incorporate exclusionary principles into their investments. This dates back as far as the 18th century, with the Methodist Church in the US being one of the first to begin excluding investments in so-called sin stocks, including alcohol, tobacco, and arms, based on religious and moral values. Similarly, Muslims used this strategy to develop investments that comply with Islamic law, commonly known today as Sharia investments. The Quakers were another religious group in the 1700s to follow in the footsteps of the Methodists and establish investing guidelines for their own followers, mainly focused around avoiding any participation in the slave trade. This faith-based approach was the origin of ethical investing and laid the foundations for what was to come in the years that followed. 1928. Moving into the 20th century, an ecclesiastical group in Boston were the first to formalize a negative screening process within their Pioneer Fund, the first publicly offered, negatively screened mutual fund. Negative screening is the process of excluding companies that do not comply with specific preset social or environmental criteria, such as those sin industries mentioned previously, including alcohol, tobacco, and arms. This was the first tool used by asset managers to incorporate ethical considerations into investments, hence why the process is referred to as traditional ethical investing, and why most funds today are still built on exclusionary principles. 1970s. Social values took precedent over religious ones in the 1970s, which was a decade of great social unrest. An anti-war movement began in the US, sparked by tragic images which emerged from the Vietnam War, whilst many investors had boycotted South Africa due to the apartheid regime which was in full force at that time. It was also the decade where issues such as equality for women, civil rights and labour management were brought to people's attention. All this propelled practices of sustainable investing, referred to as socially responsible investing, or SRI. 2000. The most rapid growth in socially responsible investing has taken place since the turn of the millennium, which is unsurprising given the mounting risks to our environment and society from global warming and the depletion of the world's natural resources. The shift towards SRI investing allowed for the inclusion of companies delivering positive social, environmental, and governance outcomes, alongside the broader negative exclusions being applied. This added layer by which you invest in companies with positive ESG performance relative to peers is referred to as positive screening or best-in-class investing. This approach also includes engagement, where the primary purpose is to encourage companies to adopt best practices and policies through meetings with management of potential and current holdings. This move towards a more inclusionary process addressed some of the concerns that by simply applying a negative screen to a fund, you could be increasing the risk by excluding large swathes of the investment universe and hence reducing diversification benefits. A significant milestone for socially responsible investing took place in 2000 when the United Nations Global Compact was founded as the world's largest corporate sustainability initiative, set up to help companies align their strategies and operations with universal principles on human rights, labour, environment, and anti-corruption. 2004. In 2004, the UN Global Compact produced the landmark report, Who Cares Wins, providing recommendations on how to incorporate environmental, social and governance issues into asset management, securities brokerage and associated research functions. This is where the term ESG investing originated. ESG considerations are now integrated into a large number of fund investment processes, regardless of whether they are being marketed as ethical funds. They are being used as a key element of the risk management process, as companies failing on either the E, S or G tends to pose higher risks, including litigation, operational and reputational risk, to name a few. As the universe of sustainable investments has grown, it has, however, become important to discern the companies delivering true benefits to our society and environment from those that are merely using the term ESG as part of a marketing strategy. Greenwashing is the practice of making misleading claims about the environmental benefits of a product, service, technology, or company practice, which can make a company appear to be more environmentally friendly than it really is. It is therefore the responsibility of the financial services industry to maintain high standards and transparency for investors regarding the sustainable products being offered. 2006. 2006 marked the year that the term impact investing was coined by the Rockefeller Foundation, which was a foundation established in 1910 to help promote public health and address global challenges. The term impact investing emerged globally as a way to describe capital deployed with the intention of having a positive impact alongside a financial return. Impact funds put a larger emphasis on measurement, often producing an annual impact report for clients which quantifies impact at the fund level, as well as the individual company level. This added layer to the investment process, which places fund managers accountable for what they are claiming, explains in part why impact funds have become so popular in today's market. Another significant breakthrough for ethical investing, which took place in 2006, was the creation of the UN Principles for Responsible Investing, which were again a way to connect environmental, social, and governance issues with the investment world. Institutional investors are encouraged to sign the principles and commit to adopt and implement them. As of today, there are over 3,400 signatories. 2015. The drive from policymakers and world leaders to change our society's attitude towards sustainability continued until almost a decade later, when a new dimension to ethical investment was born out of the creation of the United Nations Sustainable Development Goals, or SDGs as they are commonly referred to, which were created as a blueprint to achieve a better and more sustainable future for all. This was another call to action by the UN, who set a target date of 2030 to achieve the 17 goals, which include no poverty, zero hunger, good health and well-being, quality education, gender equality, and climate action. Importantly, for ethical investing, the SDGs created a standardized way funds are able to measure impact, helping towards creating a common language within the ethical and sustainable investing space, which is desirable. Many impact funds today map the companies they invest in to one or more of the SDGs as long as they can evidence that they are contributing towards achieving the goals. Following on from the development of the UN SDGs, leaders from nations across the globe came together for a common cause to combat climate change and its impacts on the world through the signing of the Paris Agreement. The agreement set out an ambitious goal to keep a global temperature rise this century well below 2 degrees Celsius above pre-industrial levels, as well as to limit the temperature increase even further to 1.5 degrees Celsius. The Paris Agreement set a requirement that all parties put forward their best efforts through nationally determined contributions, or NDCs, and to strengthen these efforts going forward. Parties are also required to report regularly on their emissions and on their implementation efforts, with a global review every 5 years to assess the collective progress towards achieving the purpose of the agreement. Today. As you have seen, ethical investing has come a long way since the 18th century, beginning as a niche form of investing, considered mainly by faith-based investors who are less interested in generating financial returns, to now being considered a mainstream area of investing, which is being incorporated into the portfolios of a diverse range of investors globally. The journey of ethical investing has seen a move along what is commonly referred to as the green spectrum, where the options available to investors have moved along the spectrum from dark green towards light green. This represents a shift from a more strict ethical investment approach, which places a greater emphasis on exclusion, towards a more flexible and pragmatic approach which allows for the inclusion of holdings on the basis of positive actions. More recently, we have also seen a stronger focus on the social and governance aspects of ESG, as opposed to just the environmental considerations. This shift was exacerbated by the coronavirus pandemic, which began in 2019 and forced global lockdown measures in an attempt to control the spread of the virus. A spotlight was shone on how well companies are being run, including the sustainability of business models and governance procedures which impact long-term performance. Whilst we have seen a move towards the lighter variety of investing over the years, there are still options available for every type of investor, including those with stronger ethical convictions. The benefit is that the universe has become much more diverse in the strategies available, meaning that socially conscious investors are able to gain access to the main asset classes they require and build an investment portfolio whereby they can achieve both goals of investing responsibly as well as achieving a financial return.